Asia, which is quite mixed right now. A few of the markets have slipped in the past few minutes, but you have some which are holding up well.
The daily upper limit for the Nifty is at 18,521. So these are near-term resistance levels to watch out for.
My question to SEBI would be, what is so broken in the way the current system works?
Revenues have declined 1%, but they've come in higher than the poll.
Dazzled the market, and there goes the bell. So let's kick it off then, about 40 to 45 points up. That's what we're getting at the open.
The fact is that segments of, as the results have shown, segments of our economy are doing well.
I believe we should be growing in the range of 12 to 13%.
Headline numbers, revenues up 17.5%, but the EBITDA has barely moved, and as a result of which the margins have come off by nearly 300 basis points.
Most of the incremental rate hikes which the banking system had to take on the loan side has practically gone through.
We're at 18,400. It's a good opening, currently up close to about 0.5%. But I think the level to track will be that 18,450 level.
Anyone who possesses a 2,000 rupee note can either exchange or deposit that note in any of the bank branch.
Today, for the markets, we continue to trade higher, 18,400 on the Nifty currently.
Hello and welcome to Closing Bell. That was the day so far. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is the pretty lady in pink, Surbhi Upadhyay, and we've got Nigel D'Souza in the newsroom. Good afternoon, Nigel. Very, very quiet, right? I remember that we began, mid-cap radar, we began trading our HDR by saying the Nifty is hovering around 18,400, and that's exactly where it is, even right now. So we had that initial gap up opening, we built on it. The Nifty opened up 45 points, but again, in the first 15 minutes itself, we scaled up to levels of about 18,400, and after that, it's been an absolutely flat point, just up 20 points from that level and down 20 points from that level. So very, very steady. But the up move has been pretty good. On Friday, if you remember, the Nifty had gone down to levels of 18,650 towards 18,060. Towards the end of last week, we had that correction in the markets. On Friday, we went down to levels of 18,060, and then we had that recovery take place. On Friday, towards the end of trade, on Monday and even today. So in a span of about 2.5 trading sessions, the Nifty has gained close to about 340 points. Banks are holding firm. The Nifty Bank is currently up nearly about 200 odd points. Today is the Fin Nifty expiry. But top honors go to the Adani Group stocks. What a rally in individual names. Adani Enterprises today is up close to about, 12-13%. Yesterday was up 20%. So in a span of 2 days, Adani Enterprises is up 38%. Adani Ports has seen a rally of close to about 9%. And just a quick update, even as our markets are holding steady and firm, Europe is on the back foot. The CAC is down close to about, 0.7%. The DAX too in the red.
Oh, absolutely, Reema. I was, in fact, looking at those markets right now. This whole debt ceiling impasse, that's not really helping matters. These are the rates coming in from European indices. A lot of the Asian markets have had a pretty bleak session, whether you're looking at China, Japan, Hong Kong. A lot of these markets have lost between 0.5% to 1.5%. So given that context, maybe a performance is not too bad. Pull up the US 10-year yield and even the US 2-year. Yields are slightly inching higher. Till now, the market has absolutely ignored whatever's happening on the debt ceiling. It's just a lot of rhetoric and brinksmanship that's been going on. But now it seems that there's some hint of caution, at least in the bond market. And equity markets are also approaching things, in a slightly more sanguine fashion. So let's see how this plays out. But for us, as Reema mentioned, it is the Adani rally that's been absolutely breathtaking. The stocks are flying between 5%, 10%, and even more on the likes of an Adani Enterprises. So that's definitely something to talk about. The index, that's the entire Adani pack coming up for you. At the index level, you'll argue that from an index trader's perspective, this day hasn't done much because you've not made money. You had that gap up at the start and it's been look at the chart on the Nifty. There is no movement. So how do traders make money when a chart is as rock steady as that? For a positional person, it's not a problem. But for those who are looking at, trades in the day, it's perhaps been a little difficult. Having said that, individual stocks, now that is where all the action is. And the mid-cap index is going to tell us that. Pull up the mid-cap index, which has actually done very well today. Again, outperforming the Nifty. So that trend that we had just about 4 or 5 sessions ago, where mid-caps were the real toast of town. That's come back 0.7% higher on the mid-cap index. And I will just leave you with some names, whether you're looking at a Route Mobile. Route Mobile was a great number, and we've seen a lot of incremental follow-through buying come in. Delta Corp is up and about today. You have some of the financials like RBL Bank and a couple of others as well that are doing pretty well. MCX numbers went down well with the market. So you were seeing incremental buying. Even on the large cap screen, actually, Divi's, a lot of incremental follow-through buying coming in, where the market has been convinced with numbers. But Nigel, I guess, tough day purely for the Nifty trader. There's not been much elbow room to move around there.
Well, if you're looking for entertainment, then you'll get it in the last 55 minutes. I'll tell you why. The Nifty Financial Services Index, that's the one that's unable to get past the 19,500 odd mark. I recall a couple of expiries ago. That's on a Tuesday itself. We were talking about the Nifty Financial Services Index having resistance at around 19,550, 19,600. Two Tuesdays down the line, we're still at that mark itself. So that's telling you that the Nifty Financial Services Index, that's facing some resistance at around 19,500. If we can get past that mark, then we're looking for a bit of an up move. But otherwise, at higher levels, what is clear on the Nifty is we are seeing some bit of selling pressure. So the Nifty, in fact, is now nearly what we saw. 85 points high is nearly what we saw in the first hour of trade itself. So let's see how this goes. The Nifty Bank, for the second day running, is underperforming, and the Nifty Financial Services as well. Something tells you that the Nifty Bank and the Nifty Financial Services Index, they are bracing for a 3 to 4% move, either which direction. So the bulls will be hoping it's in the positive trade. Surabhi?
Okay, let's find out how you should position yourself then in the last hour of trade. Mitesh Thakkar is now with us with a few closing strategies. Mitesh, have you taken any trade at all on the Nifty or on the Nifty Bank today? What have you made of these absolutely rock-steady moves?
Oh, good afternoon. So, we've been carrying some long position on the Nifty, but on the Bank Nifty, I maintained that a breakout will happen once we start seeing the Bank Nifty get past 44,150. That's on the spot. We're roughly about 70 points away, and if that happens, then I think, that should give some kind of momentum on the upside to the Bank Nifty, which in turn will also help the Nifty, move further up. So, in that sense, there is long bias, but from a trigger point of view, I'm waiting for that pivot of 44,150 to be taken. On the stock side, then I have a couple of buy calls. The first one is a buy on PEL. I think that's a stock, which is doing very well. So buy here with a stop at about 760 for targets of around 810. And UPL is reversing from an extremely oversold level. So this could be a buy as well. Keep the stop below levels of 670. Look for a bounce back to about levels of 700.
Okay, got that. Mitesh, thanks for the calls. We'll come back to you in a bit for more strategies and ideas. But since it is all about individual stocks, then let's look at some of the big movers and shakers of the day. We'll discuss Borosil in a bit. Mangalam will join in. That stock's down 9%. It's entirely driven by results disappointment. That'll be on our radar. MCX is the one that's actually reacting positively. So that's one big mover on the way down. The one on the way up in terms of results is actually MCX. So let's go across to Surabhi to figure out what has worked for the company. Surabhi?
Thanks so much for that. So MCX had reported the earnings day before yesterday. It was a decent set of numbers. The revenue was down 7% sequentially. The operating profit was down 94%, and that was largely due to higher software expenses, which has been an overhang for them for quite a while now. The margins have come in at 2% versus 23%, obviously because of higher software expenses. The management reiterated on the conference call yesterday post-market that the transition to the TCS platform will be done before 30th of June 2023. So that's a big positive. Investec has written on this, and they said they have a buy rating on the stock with a target price of 1780. They said that the options average daily value was up 16% sequentially, and futures declined 3% sequentially, but overall operation performance was strong. They said that the continued traction in options volume and newly launched mini contracts will help their revenue growth going forward. And also, for the first time, management sounded confident on the software transition, but that still remains a key monitorable for MCX.
Thanks a lot for that, Surabhi. Prakash Diwan as well as with us. Prakash, what do you make of that? MCX buzzing around in trade, hopes that finally, that software rejig will come about. Your take?
Good afternoon, Nigel. I think that's the only trigger. It's not one of the triggers that the market is watching for it. But I guess that's the only trigger for the simple reason. Ever since we saw, the earlier software provider get out of the setup and MCX was left on its own, they've had to kind of do a lot in terms of troubleshooting. And that's one of the other reasons why they've not been able to grow volumes in some of the, some of the segments which very promisingly potentially look good. So I think MCX is a stock that you buy for the long term, for structural changes that support the business rather than any quarter-on-quarter kind of a thing. So they've been expensing the software issues, software expenditure through the P&L, and that's why there's a negative impact. But if 30th June is when they can get this transition done, and if, let's say, a month or two later, there's no teething problems, they overcome all of that transitionary issues, I think by probably July end or early August is when the business will start revving on its own in a very different way. So I would wait till then. Don't be in a hurry because these deadlines do tend to kind of get extended, and even after the adaptation, it could kind of take some time to smoothen out. So, but once that happens, we'll probably start figuring in the volumes and the revenue to build up over the next few years in a very smart way. Quite positive on the space, and there's no competition really in that sense. So, yeah, so makes sense, but give it another couple of months.
Another stock that I was looking at is Dreamfolks. This is a company that provides the technology platform for credit card issuances, for credit cards, for the users of credit cards to access airport services like lounge, and the numbers look very good. The revenue growth is 16.5% on a quarter-on-quarter basis. The gross margins have gone up by 160 basis points quarter-on-quarter. EBIT margins are up 150 basis points quarter-on-quarter at 13.8%. The profits have jumped up 49% on a quarter-on-quarter basis. I'm not looking at it on a year-on-year basis because last year's the base was low on account of COVID, but these are looking, these numbers are looking very good. The stock is up 4.5%, though it's come off from the early morning highs, but at 531, it's significantly above the issue price. Remember, this is one of the recent listings, Dreamfolks, and the issue price was 308 rupees. Let's just pull that stock up and perhaps a 6-month chart of Dreamfolks. Another one that we're tracking is Borosil. That's under pressure after the company reported its Q4 numbers. Mangalam joins in with the details. Mangalam, what were the pressure points?
Well, the biggest pressure point was a couple of, data points in their income statement which showed an increase in expenditure. One was employee, the other was operating expenses. The stock currently at the low point of trade. If you just take a look at the numbers, 17.5% revenue growth, not really a problem, but it was the EBITDA which was largely flat. That meant that the margins compressed by about 300 basis points, and as a result of which the net profits fell by 35% as well. But if you take a look at the internals out there, the gross margins actually expanded from 65.5% to around 69%, but the increase was in expenses was led by operating expenses and employee expenses, and that would largely be because one of their opalware plants came on stream this quarter itself, and as a result of which it led to increase in the other expenses. In terms of their categories, if you look at the scientific business, there was no growth in the revenue. In fact, there was a decline in their operational performance. This could have been because of a high base same time last year. Remember, COVID-related issues led to a higher revenue coming in their pharmaceutical business. And the second part was their consumer revenues, which grew by around 28.5%. Out here as well, the company is perhaps reinvesting in some of the marketing activities, as a result of which the operational performance was weak in the consumer revenue as well. The company has earlier here on CNBC-TV18 spoken about 22 to 23% margins in FY24 with increase in their capacity utilization for the opalware plant going all the way up to 70%. So those are a few things that we'll be watching out for. Apart from that, the biggest trigger, of course, is the demerger and separate listing of the consumer and the scientific divisions, and which is awaiting a couple of regulatory approvals as well. So that should happen soon too.
All right, got that. Thanks, Mangalam, for the details there. So disappointment on Borosil today, but Mangalam explains it's on account of some of those cost factors that have come through. Prakash is, of course, with us. Good afternoon, Prakash. I don't know, do you track Borosil by any chance?
Oh yes, of course. So okay. This is something which has probably been a great stock in terms of expectation, but if you see where they've got muddled, a couple of acquisitions that they have made in the recent years. I mean, it's not very recent, but about in the last 5 years. That has not been something which they've been able to integrate in a very effective way, and the distribution still lacks a little bit of punch. I mean, except for some key channels like the CSD and all, you really don't find the products, being present as much as the competition does, which is now Pala and all. So this is a fiercely competitive market. It's price sensitive. It's brand conscious. So, you need to be up there doing all the right things. And that's exactly where the consumer business probably is pulling them down. And the pharma or the scientific equipment business, which should ideally be correlated to the growth in the process and chemical and pharma industry, should grow much faster because they have almost like a monopoly there to be. And any lab you go into anywhere in the country today, any company that does anything to do with chemicals or fluids or solvents, you'll find them there. But that needs to kind of get carved out separately, and then the market will probably be able to differentiate between the two very clearly. And that's where I think everybody's waiting for that particular corporate action to be effected. Till then, I think the struggle will continue. I think 300 basis points is not a big miss in terms of margins, but it does kind of give you an excuse not to buy into the stock.
Okay, got that. Prakash, we'll keep the conversation a little short today. Lots of earnings coming in. But we're looking forward to the next time that we have you on the show. So you have a good evening. We'll take a break on that note. On the other side, we will be in conversation with Anuj Podar of Bajaj Electricals, talk about the company's Q4 print. And then our next market conversation, we'll have N. Jaykumar from Prime Securities joining in with some perspective.
Welcome back. There's been a bit of a slip in the markets. The Nifty was hovering around 18,400. It's down about 25 points from that level. Names like HDFC Bank and HUL, both these stocks have seen a bit of a knock. HDFC Bank has now dipped into the red. Remember, today is the Fin Nifty expiry, so the last 40 minutes are going to be very crucial. The stock on our radar right now is Bajaj Electrical. It's moved to the high point of the day. It's got a gain of close to about 1% right now. But today the stock, I think, has hit a high of 1259, which means it's very close to its 52-week high of 1265. That's what our data seems to suggest. When it comes to their Q4 numbers, the lighting segment was a bit subdued. On the whole, it's a good quarter. It's a revenue growth of 11.7%. Margins have expanded to 5.7% versus 4.7%. And the profitability is up close to about 32%. Anuj Podar, the MD and CEO of Bajaj Electrical, is with us on the show now. Anuj, afternoon. This is Rima here. Can we begin by talking about your lighting business? Revenue growth at just 1% on a year-on-year basis. Profitability or margins have come under pressure. Tell us what happened in the lighting business.
So thank you, Rima, for having me. The lighting business, while it's flat overall, a professional lighting business is actually growing very well. It's a consumer lighting business that is soft, has seen some degrowth. We're seeing that trend in general and consumption side, where last 2 quarters consumer lighting has been soft for an industry, but I'm happy that we're making up for it through the professional lighting business. And just on an overall annualized basis, if you see lighting as it shows on your screen, the margins have expanded on an annualized basis.
Okay. What's the extent of softness in the consumer lighting business?
So in general, consumption demand across is, soft. We're seeing that in appliances, etc. too. It's in about a teens. So our degrowth in consumer lighting is in the early teens. And our growth in professional lighting is also in the slightly later teens.
Okay, all right. Hi, Anuj. Good afternoon. Anuj, if you could tell us, what about rural demand? I recall the last time we chatted, you had briefly mentioned that rural demand is still lagging. Any change out there, or it's still soft?
So to be honest, Nigel, I think rural demand is soft, but we're seeing that a little bit on the urban side too. But I do want to plug in or take the credit for the fact that our company, despite that, has actually grown our revenues and top line. And when I look at it versus industry, I think we're outgrowing them. So the good news for us is that we're doing that and gaining market share across most segments that we're operating in. And this is without dropping margins. So we're maintaining margin percentages, but actually growing the absolute profitability.
Got that. Hi, Anuj. I'm just going back to the consumer products business where there is growth. There's top line growth about 9-10% year on year. But margins are under pressure, whether I compare it with Q3 or I compare it with the last year. Give us a little more color on what's happening with your appliances business. What are the trends like? And for FY24, what would be your expectations from the business?
Sure, Surti. So if I look at a consumer business, it is grown about 9%, which I would again call out is ahead of industry, which means we're gaining market share. This is in a tough environment. If I break that up further, our appliances actually grown fairly well. It's grown by almost 16%. Fans has been soft for us this quarter, or rather largely flat. Again, I think both of these numbers are ahead of industry trends. And this is done despite the fact that we've not dropped prices to actually hurt our margins. So our margins actually are up on a Y-on-Y basis.
I think last time you had indicated that on fans, there was some inventory, some of these non-star rated fans inventory that was hurting y'all, and y'all were yet to clear it. Could you give us an update on that? And what about the possibility of a price hike? Because you did say the movement, when the company needs to transition to BEE fans, there would be a price hike which you need to take to pass on the entire burden.
So the transition has happened or kicked in effective 1st of January this year. All our non-star rated fans from our side as manufacturers across industry, we exited that as of 31st December. Having said that, Q4 has seen a fair amount of carry forward channel inventory across the value chain of these non-star rated fans, which is why the primary sales in Q4 for the industry has been soft. Relatively speaking, again, we managed a flat growth on fans, which means no degrowth, and we made up for that, quite honestly. Volumes have seen a little bit of a degrowth, but we've been premiumizing. Our portfolio mix is better. Our sales in premium fans actually has seen a pickup to contribute, or rather to compensate for the degrowth in the sub-economy fans. So on an overall basis, we've exited flat. I do think the outlook for the next 2 quarters for fans should be better, because as the channel inventory starts getting destocked, I think you will start seeing primary sales pick up sometime towards latter part of Q1 and definitely into Q2. And the question on pricing, I think, to be honest, pricing is not fully passed on to the consumers. It's again a function of demand elasticity. So we've had to absorb some of this incremental cost because of the star rating in BEE, and only pass on part of that pricing. But that's baked into the margins, and that comes back to the original point I was making. I think you've balanced the revenue and the margins fairly well to make sure both are actually positive for us.
Okay, all right. Anuj, I recall a few quarters ago I asked you, I said, what about the EPC business? You said it's going to turn around. It's turned around. I think after a couple of years, we have a positive number on the profitability front from EPC. But what's the status on the demerger?
So Nigel, the status on the demergers, our next hearing of NCLT is on 8th of June. Assuming that all goes well, that should be the last hearing, which means we are targeting a demerger effective end of Q1, that is 30th June. So that 1st July, we will be 2 separate companies. I don't expect any surprises on that. In terms of just the numbers on EPC, like you said, now after about 3 years, we've exited that on a break-even basis. But importantly, our order book is looking up. Our revenues are now trending up. Our order book, to give you a sense of numbers, was about 800 crores last March. We've exited this year at a 1600 crore order book. Our revenues in Q4 on EPC are up. And I think this coming fiscal will see a growth in revenue on EPC with a positive profitability.
Okay, Anuj, so then leave us with a yearly outlook. I mean, FY23, if I look at all the businesses put together, you've had about almost 14% growth at the top line. The margin has improved, blended margin, decent expansion compared to FY22. So FY24, your sense on top line expectations and margin trajectory, can you better this 7% number?
Survi, I know you'd love to get a number out of me in terms of percentage growth, etc. Quite honestly, I don't know. We'll have to see how the market moves. But we're committed that we hopefully will keep finding the right balance between growing our top line without hurting margins. All things well, unless something worsens from here, I do expect margins to improve clearly. But most importantly for us, we are chasing market share growth, and we are quite committed that we will achieve that. We've done that for the last 3 years in a row.
All right, Anuj, good luck with the plans then. And thank you for joining in and giving us a lot of the details there on the business. That's Bajaj Electric. It's been quite a decent quarter for them and a pretty good, well-rounded year as well. Okay, with that, back to the market, which continues to be, I think, fairly steady. Has anything changed from 18,400? Well, a little bit, about 40 points shaved off from that level. Now we are getting into that expiry zone, the financial services, Nifty financial services expiry. Some of that interesting drama, or the entertainment, as Nigel call it, that's perhaps going to start playing out. So we have our eye on the screen, but we also have to welcome in our next guest on the show. N. Jaikumar, Group CEO and Managing Director at Prime Securities, is with us. Jay, it's always a pleasure to have you on the show. I remember our last conversation where I think it was just after the Infi debacle, Q4 debacle, and I remember you saying that expect some of this money to start moving out of IT and rotating into pharma. What's your view? What makes you bullish on the space? Are you holding that call? And what kind of companies? I mean, there's a Mankind, for instance, in this last couple of weeks, we've seen a new listing, and that's an entirely India pharma story. Then there are the US companies. Gland, a name like Gland is suffering big time. Divi's has had a good run. It's a very diverse sector. So therefore, I want to ask you to drill down a little deeper and ask you what in pharma should one consider?
Well, there are two. For starters, thank you for having me on the show. The important thing on, when we last looked at this was we saw the trends in technology and took a call that people will downgrade their holdings in the technology space and move to possibly another export-oriented theme, which is, in this case, pharma. 4 or 5 things have happened. One is that a number of smaller companies in the US have actually fallen by the wayside. And it's also happened in terms of event risk being higher for smaller companies, even in the Indian context. And if you've noticed, the markets have been positioned quite negatively on pharma till recently, which is why if you see, for instance, just to give you a comparison, like banking, people have been positioned long. Results have been, in many cases, better than expectation, but prices have come off subsequently. In pharma, for instance, many of the results have been disappointing. And people have actually, if you see the research reports, people are justifying 25 to 27 EV/EBITDA multiples, 30 times PE multiples, 30 and north of 30. So in that context, markets, despite seeing not great results in the pharma space, have actually started moving up. So A, the positioning of the market is in favor of pharma stocks. That's number one. Number two, the general commentary, if you can go through the analyst and the conference calls of managements, indicate a declining pricing pressure, especially in the US, which means that the US, which is the world's biggest market for pharma, is seeing a dramatic, I would say dramatic, maybe an exaggeration, but a strong decline in pricing pressure over the last few quarters, especially on the generic space. So generics in the US, good market to good sub-segment to track, where the pricing pressures have come down, logistics costs have come down, input prices have come down, and consolidation in the industry is taking place with a lot of smaller companies having fallen by the wayside. A few, in fact, have gone into bankruptcy as well. That's one particular takeaway. The second is, I would say that the domestic stories and the manufacturing part of it is buttressed by a big call on PLI. There are 1 or 2 companies that have got large PLI approvals. And the largest in this has been a 2,400 crore PLI approved for one single company. Now, the advantage of a PLI investment is many of the pharma companies, including this one that's got the PLI approval, are cash rich and very, very low on leverage, if that. Most of them are net cash positive. The PLI has meant that for a 2,500 crore investment, you probably get operating incomes of operating margins of close to 30 to 40% because you're actually shifting out from places like China in terms of sourcing either the intermediate or the starting pharmaceutical ingredient. So from that point of view, you're talking about almost 700-800 crores of operating EBITDA, plus 1/5 of the PLI comes back to you in terms of government payments back to you. So many of these companies in this space, especially the larger ones, could get up to 800 to 1,000 crores of additional EBITDA purely because they've moved into a PLI here. And I think just like the PLI has benefited so many other sectors, pharma could be seen to be that sector here. The third thing is that some of these companies have actually gone through with their capex related plans and will end up becoming seriously cash flow positive, and more importantly, free cash positive. And that actually could be a big plus again for the years to come. And apart from all this, logistics input prices have come down. So margins actually are on the mend. So given all this, I think pharma is a good space to be in. Add to this the fact that the dollar index actually held out at 100.5, did not break down, and on the way up is actually now close to 103 and a little beyond that. Were the dollar, which had been shorted into through these crises of the banking system, etc., in the US, were that to actually the dollar not to decline, it's possible that the Indian rupee may go past 83 and head towards 85, 86 over the next 6-9 months, is the house view that we have, which essentially means that that's one more tailwind for the pharma space. So this is a kind of a deep dive into why we like pharma. And most importantly, as I said, the markets, the funds, both overseas, FPI and local, are actually under position. And most of big pharma companies are high on promoter holding, very low on any pledge, low on institutional holding, and even lower in this context as of today.
All right. Hi, Jakes. Good afternoon. Always good hearing your thoughts, Jakes. I want to ask you about the cement themes. That's one of the plays you have, right? Getting into an election year. But could you tell us how do you play this theme? Would you look at the big boys? Would you look at the smaller names? And if any view on ACC and Ambuja, because they have been the big movers in the last few days.
So most of these companies, again, in this space are not that heavily leveraged. Consolidation is happening all the time. And I think the bigger theme is not so much cement. I think it's cement and steel in the context of an election year. So you would probably have multiple companies that will be beneficiaries of this theme. I believe the capex, just look around and see what's happening in just Bombay alone and what plans, the state talks about how they're going to reform and change radically everything that is there in the Bombay skylines. And it's happening as we speak. So whether it's cement and steel from a national perspective, or more importantly, capex related in an election year and 2 years beyond. So this is a more general call on that. Again, I feel while cement is well owned by a lot of funds, steel, for instance, isn't. And one of the tailwinds or triggers for this could be something that's happening on the geopolitical front, where every pronouncement of an international leader seems to have India as his or her friend in a geopolitical sense. I think this is not falling on deaf ears. China is keen to get back what it's seeing as if not an exodus, but people tactically moving manufacturing out of China into other parts of the world, notably India. So whether it's actual physical movement of money, which is the China-India play, and there's more money coming to India now moving out of China, after the last tactical play into China did not work out. Number one. Number two, FDI flowing into India, where people are setting up manufacturing bases here. And number three, from a geopolitical front, the fact that India is mentioned in the same breath as the best friend of the most favored nation kind of thing in most countries is not falling on deaf ears. And I do believe that China will need to do something which it hasn't been able to do. Demographics aren't helping them. My assessment is that they may brute force this with a stimulus that could be pretty dramatic. And if that were to happen, a sector like steel or some of the commodities could actually see activity where, in any case, after high interest rates in most, if you see the last 150 years of high interest rates, every government that has sought to pay down its debt on the back of high interest rates, higher principal and interest repayments, has sought to do that through capex, has sought to do that through construction and reconstruction of real activities and real assets in the economy. So from that point of view, there's a developing capex theme which I suspect will happen, and more specifically, China with its stimulus could be the joker in the pack, and this could happen pretty soon because the developments, as I said, on the geopolitical front and on the FDI front, as an outsourcing front, manufacturing, exports, etc., India features everywhere. So from a market standpoint, I think every dip will be bought into, as we are seeing. Markets could make new highs, and specifically, some of the themes that I talked about are what we are backing.
Jake, so if one needs to make space to own pharmaceutical names, What are the sectoral holdings that you would recommend paring down in your portfolio? If you don't have incremental cash to put to work, say in sectors like pharma, you need to pull out, sell down some of your other holdings. Which ones would you recommend?
Pharma, I would say that movement to pharma can happen through multiple but principally the overall space. So what I would consider in that would be, maybe even at some level, well, banking still as a way to run, but tactically you could look at paring down banking. That's one. But I think the bigger theme for a reduction would be FMCG and consumer. I think that's very richly valued. It's on the strength of low single-digit growth. These multiples, like the case of Asian Paints underperforming and so many others underperforming the last couple of years, clearly indicates that money is and has been moving out of those spaces. So there are spaces that you can pull out, and I think these would be principally there.
Jakes, this has been a rich conversation. Thank you very much for joining in. Look forward to another chat. For now, we need to slip into a very short break. On the other side, we'll get some BTST calls from our technical experts.
Welcome back. Well, a couple of these HDFC group stocks actually have taken a bit of a leg down. Just pull up HDFC. That's part of the Nifty Financial Services Index. That's moved lower. And, the Nifty Financial Services Index, yes, that's the one when we started off the show. It was up close to 0.3%. Now, that's moved to the low point of the day as we speak. And also the other one is the Bajaj twins. They as well are struggling a little bit. I'm highlighting these stocks because in 30 minutes, the outstanding contract does expire. Mitesh Thakkar is back with us. Mitesh, what are the picks you have for us?
Nigel, I have two calls right now. The first one is a BDST on Concord. Keep a stop at 654. Look for targets of around 675. And the other one is a BDST on Cipla with a stop at 922 for targets of 945.
Thank you very much for that. Let's get you some important market opinion now. Earlier today, my Prashant had caught up with Mahesh Nandurkar of Jefferies from the sidelines of Jefferies' second India Forum 2023. He started by asking his view on how one should play the consumption space going forward. Listen in.
So the way to play the consumption story, according to me, is through the staples segment, and obviously there are some financial companies as well that are leveraged to retail consumption.
Again, broadly, the QSR space perhaps will fall in that category. I think you have a couple of QSR companies presenting. Devyani, I think, is presenting at your conference. Do you like that space as well?
I think the QSR as a space, once again, looks pretty attractive from a medium-term or a long-term perspective as well. But I just feel that, maybe, that space, as a whole, will probably still need to go through a period of 1 or 2 quarters where the investor expectations versus the actual delivery get mitigated. So I would rather wait for a couple of quarters before jumping into the QSR space here.
Got that. Again, on the consumer side, the real estate demand is held up remarkably strong, right? Over the last 1.5 years, even as interest rates have gone up sharply. Do you expect that to hold, this sales levels across real estate companies to hold at current levels into 24 and beyond as well? And what are investment implications then?
Oh, absolutely, Prashant. In fact, this has been our single biggest high conviction idea. And we have been talking about it for last couple of years, pretty much, from the bottom. And while our thesis has played out beautifully, even in the last 12 months in terms of the physical property market, doing quite well with the pre-sales numbers surprising on the positive side, despite the mortgage rates going up. But the stocks by themselves did not really do that well until recently. There is a lot more upside for the fundamental performance as well. I think we are in a real estate upcycle. Make no mistake about that. We are only in the 3rd year of real estate upcycle, And I think it's a cycle that should ideally unfold over the next at least 3 to 4 years.
What are the best ways, in your opinion, to play the manufacturing upturn, which we are all talking about, which we are getting to hear from companies as well? And this time, broadly, what one is hearing is that this is not driven by very large ticket sort of items like how it was 10 or 15 years ago. This is much more dispersed, much more smaller orders coming through across a variety of sectors, then perhaps makes it more durable as well. I wanted your thoughts. Go on.
Yeah, I think we are clearly at the beginning stage of a capital, of a capex upcycle. And yes, and we're not really seeing any large capital commitments coming through, but yeah, a whole bunch of capex that is happening in the process industry, like chemicals and so on. And I think the best way to play that would be through some of the engineering kind of stocks, or the capital goods stocks. The thing is, there are not that many large liquid names or the options that are available for typical global investors, and that's why you see some of these stocks have got re-rated to some extent, and that is creating some question marks that whether it's the right time to add here. But I would say that just like how we saw over the last 10 years, the consumer stocks got re-rated from 20 times to 30 to 50 to 70. I think a story somewhat similar to that will be played out in these capital goods and engineering companies stocks as well.
Okay, that's interesting. I want to kind of, it's an allied question. You also at the conference have 3 Adani Group companies presenting. That group is largely seen, and the various businesses they run is largely seen as a proxy for investment, I mean manufacturing, etc. Is there a lot of interest around that group? What would you like to hear? What are the questions which you will be asking of the managements there from the group?
Yeah, so as I mentioned, there is definitely interest on the capex cycle theme, investment theme, and there are not that many large liquid options, because some of the large names have also got some issues, especially from the European funds that closely watch the ESG factors and especially the defense related involvement as well. So we are clearly seeing investors scouting around for more ideas, especially the large liquid stock names. And and that's the reason why the investors are willing to experiment and trying to kind of look at some of the new ideas that are coming through. And yes, we are seeing a reasonably broad based interest in those stock ideas.
Okay, got it. We've not, Mahesh, spoken about banks and financial services, and you got a plethora of companies presenting there as well. So what are the best ideas from that space? I saw some of the smaller housing finance companies, very high growth, 30-40% growth, housing finance companies like Aptors, Home First, etc., which are going to be there. Where exactly will bulk of the money be made from here in the financial space?
So in the financial space in general, so we quite like the banking story for sure. And I think, given the fact that IT and banks are 2 of the largest sectors from the Indian market, both of them add up to roughly 55 to 60%, of the index benchmark. So it's very critical that you get that IT versus banks call right. And our clear view is that we definitely have a preference for banks financials, over IT. If you get that one call right, then a large part of your portfolio outperformance can be kind of so it'll be a big driver for your India portfolio performances. Now within banks, I mean obviously there are several large sort of banks, and they're trading at reasonable valuations as well. But what history has shown us is that in periods of stable interest rate environments, stable to declining interest rate environments, NBFCs tend to do much better than the banks. So we have a bigger overweight on NBFCs than on the banks.
IT is still staying away? I mean, waiting for that recession at some point in the future? Waiting for the shoe to drop in that sense?
Yeah, I would say so because, we have seen, some disappointments coming through in the March quarter. My sense is that there could be some more disappointments, will likely come through in the subsequent quarters as well. And, the mid-cap names in that space have done pretty well in the March quarter results. Some of the large caps have had issues. But I think if large caps have had issues, it's only a matter of time before that shows up in the mid-cap, companies as well.
Well, remember, you can catch this full conversation at 5:30 p.m. today, only on CNBC-TV18. So make sure you don't miss that. Well, just take a look at the markets. Rima as well as Surbi were talking about a quiet market. It's anything but quiet now, right? From the highs of the day, we have come off considerably. So it appears
you promised entertainment, Nigel. You promised entertainment. I was just thinking about it.
I mean, by nature, most of us are bullish. So, it's some bearish entertainment that we're getting right now. But quite a few stocks actually have moved lower. Bajaj Finance has moved lower. Axis Bank as well has moved lower. HDFC, that's the big one in there. HDFC, it's moved only around 0.4% lower. But it's corrected from the green into the red. And that's one stock that's putting a good amount of pressure. And that's why the markets are up only around 25 to around 30 points from around 100 points when we started off the show. Jay Bala, though, of Cash the Chaos, joins us on the show. Well, Jay, I think the market senses when you're coming. You've been fairly cautious on the markets. And in the last 10 minutes, you moved to the low point of the day. Well, let's keep the Nifty aside for the time being. Let's talk about the dollar index. You believe that the dollar index is set to burst on the upside? That will not be very, very good news for our markets as well as emerging markets. Tell us more.
Yeah, thank you, Nigel. I've been pointing out for several weeks now that the dollar index spot were to take out 103.36. I think a bottom is in for the dollar, and a period of dollar strength is likely to get ushered in. And I think, in my opinion, we are heading for fresh highs above 114.7 that the market registered last year. But, let's be conservative and take it as a slightly lesser bullish view that takes the index somewhere close to 110. That's the working thesis at the moment. But, we'll assess how the markets cross 105.5 from here. And then we can discard the view if we have to, consider it as just as a move towards 109, 110, or it's a move towards all-time high. Always good to be conservative about the move, but definitely we are getting into a period of dollar strength.
Jay, that's been your long-standing view, right? For a while, dollar bull, market bear, but we'll talk more about it. Need to get into a very short break. We'll continue the conversation on the other side.
Welcome back. We're in conversation with Jay Bala. The day has been, from a bull's perspective, slightly disappointing because 18,400 is elusive, and that's a very sharp decline that we've got. In fact, look at the Nifty. It's threatening to now turn negative for the day. Pull up some of the IT stocks. There's been a very swift decline on Tech Mahindra in specific, both HCL Tech actually and Tech Mahindra, more pronounced in Tech Mahindra. TCS and Infosys not so bad. That's the IT index. Let's pull up some of the individual big names. That's the decline on Tech M that I'm talking about, even HCL Tech for that matter. Jay, afternoon. Any thoughts on technology stocks? I mean, I know that overall you are very, very cautious on the market, but the last couple of days we were seeing some accumulation in a few names, like Infosys, for instance. Anything that you're reading on the charts?
Hi, Surbi. Yeah, I had pointed out my interaction after the Infosys results that a few IT stocks like Wipro, Tech Mahindra were high risk buys, and they are likely to head higher. And then you take the Nifty index, Nifty IT index closer to 29K, and the market has done exactly that. And exactly at this resistance levels, it seems a little bit of pressure. The frontline names, Infosys and TCS, aren't looking that good. But, it's okay structure with Wipro and HCL Tech, but it's still the mid-caps that's rallying. But even there, if I've been bullish on Persistent since last October for a record high, and it's done the record high. But right now, even that's, strong space, the mid-cap space is looking a bit toppish. So, there are multiple resistance for Nifty IT between 29,500 and 30,300. So be a bit cautious here. we'll see, for the next few days what the IT index does, and that will unravel for the medium term.
You've got a few trading recommendations for us, Jay. Why don't you, share those?
Yeah, one is a bullish setup on Everest Canto, and it's broken out of an inverse head and shoulders pattern, and a stop below 90 would likely take this stock somewhere close to 160. So it's a good tradable bet, but I wouldn't advise too much aggression on the long side, but definitely it's a very positive setup. Respect the stops and the move. If it doesn't play out, too bad. It's this stock is trying to swim against the stream. But yeah, so respect the movement. And when it comes to the bearish setup, Escorts, it's one of the weakest auto stocks. And the recent move from the March lows to the current high a few days ago, it's looking like a corrective move. So Escorts has probably completed its up move, and it's unlikely to go past 2140. So that will be the stop loss level. And it's probably going back below the March low. So an objective somewhere close to 1700 would make sense for it.
All right, Jay, what about the real estate space? My dream home is still a dream because prices just go up. But the index has done quite well in the last couple of months. Where do you see it headed? Do you think it's going to come under some pressure?
Yeah, the real estate index has done pretty well from March, and it's just a cautious note, rather than outright bearish call there. Basically, the profits that the sector has generated from March is probably coming close to an end. We want to see probably a fleeting high above the high that we saw last week. If it does that, that will be a complete setup. And we've already seen pressure come for Ghost Properties and Oberoi. So, and Nifty Realty Index is heavily weighted towards DLF, and it looks like DLF is facing an exhaustion. So, many of these stocks will come in for profit booking. So that's the caution here. Not yet bearish out there.
Okay, all right, Jay, thanks so much for stopping by and giving us your take on the index, as well as on quite a few stocks that we discussed as well. And it seems we are at the low point of the day, Jay. Let's see. Let's catch up next Tuesday and see how this goes. But for the time being, your cautious view is working. Well, let's focus on the markets then and wind down. Last couple of minutes of trade left. Well, the Nifty Bank, for the second day running, it didn't participate, so that was under some pressure. It's ending as flat as can be. The problem pocket, though, was the Nifty Financial Services Index, which played out the expiry. That came off the high of the day. In fact, in the last 1 hour or so, that one moved into the red, and it came off close to around 100 points. The Nifty IT Index that was doing quite well. Remember, the Nasdaq ended at its highest levels we've seen since August 2022. But that one did come in for some profit taking after holding strong for majority of the trading session. From stocks that were moving around, you had Tech Mahindra as well as HCL Tech. Both of them were under some pressure. Grasim as well was lower. Apollo Hospitals as well was the top loser on the Nifty itself. Divi's Laboratory continues to move from strength to strength. Second day running, good follow-up buying is what we are seeing. And in this week itself, there's just 2 sessions in, it's up 9.5%. Adani Enterprises as well did do quite well. And Bajaj Finserv did end virtually at the high point of the day. UPL, maybe the valuation argument comes into play yet again, so that stock as well put on some bid. But there was plenty of action, guys, from the broader market. So, Surbhi, Rima, what was moving out there?
Well, Nigel, I was looking at some of the high performers. I mean, if you're looking at gainers, and MCX definitely stood out in terms of result reactions today. That was a big one. And the entire Adani group, right? So for all the fall that we've seen in IT and in some of the large banks, the Adani group rally was pretty much intact. Adani Enterprises, 13%. Adani Wilmar, about 10%. Some of the smaller names like Adani Power Transmission, 5% limits on a lot of these stocks up and about. Then beyond that, there were some other movers and shakers on the way down as well. And NCC really stands out. About a 9% down move on NCC. Some concerns perhaps. Not sure if it has to do with local politics, but about 9% gone from that stock. HEG's results were not liked by the market. It was down about 6%, took down graphite with it. So those were some of the severe result reactions as well. By the way, Varroc came out with numbers in the afternoon, late afternoon, and those numbers were quite good. Strong margin expansion. That's 6% up move on Varroc last I checked. We'll just put it up on your screens. Yeah, so even in a falling market, some of these mid-caps, Rima, they really managed to move around. All very earnings or news specific.
No, absolutely. So some more earnings reaction that we saw in today's trade. So Fusion Microfinance, 37% AUM growth. So that stock managed to close up in the green. Garvare Technical Fibers was up close to about 1%. Shreya Shipping on that delisting news has been gaining ground over the span of 2 days. It's up close to about 27%. Gland Pharma got hit hard yesterday, but today it's seen a bit of a rebound. Root Mobile has rallied on pretty good volumes. On the losing side, some of yesterday's big winners like an LG Equipment, BEL, a Narayana Healthcare, these stocks moved up considerably yesterday on the back of good earnings, but today they've come in for some amount of profit booking. But by the close of trade, what started off and was looking like a flat, steady session, a positive session, markets have given up all their gains. The high on the Nifty was 18,419 and the last tick on the Nifty was 18,333. We're talking about close to an 87-point drop from the day's high. The Nifty Bank, the final tick is actually in the red, so the Nifty Bank too has slipped close to about 200 points from the day's high. So in a way, a bit disappointing, though the advanced decline ratio held up in favor of the gaining side, but just very marginally. But with that, it's a wrap on Closing Bell. Don't go anywhere. Our Tuesday special, Commodity Champions,